Are you a swing or position trader and want to learn how to generate income from time decay by selling weekly options? Well, today I'm going to show you why selling short-term options around compelling chart patterns create numerous high probability trades for us each week. Stay tuned. It's MasterTrader.com. I'm Dan Gibby, a master trader, and I've been actively trading options for over 25 years. Be sure to subscribe to the Chart of the Week and our Master Trader YouTube channel if you want to learn to make money investing and trading in the markets. Today I'm going to show you two weekly income trades we found in our live options trading course a few days ago and show you why using charts and time decay overwhelmingly stack the odds in our favor for maximum profit. Okay, let's get started. This was an email I got the other day which prompted me to prepare this lesson for us today. It's one of our students in the options strategy series for investors and traders. And there was an example where we sold a 10 lot of some out-of-the-money puts for $950. Mr. Wall is asking about, the cost to put this on, the theta decay, the maximum gain. We're going to come to that at the conclusion of today's lesson. But let's first have a little review of the importance of this topic. Buyers of options, and we do those also, of course, they provide benefits if you know what you're doing. We get limited risk, we get leverage, we get greater return on investment, we capitalize on patterns where multiple time frames are in alignment and we're expecting a big move. Well, we do it intelligently and put the benefits of option pricing on our side, unlike the novices. Sellers of options, though, is our specialty, and that's what we're going to be showing you today, selling options on short-term instruments. We profit through time decay, which I'll show you more in a moment. But the beauty of selling options is we can do these strategies in all market environments, choppy, ugly, uptrend, downtrend, and we love high volatility because we get paid more for the trade. I'll explain that also. When we have directional trades, we want pretty much precision on the multiple time frame patterns. But when we sell options, as I'm going to show you, you don't have to time the entry with precision because of the nature of the bet we're taking. So Master Trader, we teach our subscribers to use directional and income producing strategies all the time per the charts. So let's talk about what time decay is. It's referred to as theta, as one of the Greeks in the option pricing model, but I don't care that you know the term. I just want you to know the concept. So when option buyers go to the market to buy a call or a put, that costs money. And the extrinsic part of that option is called time decay, which evaporates day by day in the benefit of the option seller. So that's what we are going to do, is intelligently sell these options to the novice option buyers. The majority of options expire worthless. Now, we focus on selling short-term options because, as you can see in this time decay curve, the closer you get to expiration, the more rapid the decline of that option's value becomes. It's like a melting ice cube. If the stock doesn't perform for the option buyer, his or her remaining price of that option is just going to deteriorate, and that's what we want to capitalize on. So let's just keep it simple. These are the only things a stock can do: uptrend, downtrend, sideways trend, choppy, volatile mess. So we're going to use patterns, and instead of when we take a directional trade where we're making a directional bet of higher or lower prices, here we're making a bet that the pattern is not going to violate a certain area. So all we're doing is calling a top when we short call spreads, and we're just calling a bottom when we're selling put spreads. So let's say we sell a put under support. We're going to profit and make maximum profit if the stock goes up, if it goes sideways, and it can even go down a little bit and we still make our maximum profit. Short calls, just the opposite of that. So the beautiful thing in selling options is the premium that we take is like a cushion to be wrong. So the stock can go against us and we still make our maximum amount of money, provided at expiration it doesn't go beyond our break-even point. So like an insurance company, if you buy auto policy, home policy, the insurance company is pro rata accruing a small portion of that gain every day time passes, and they don't have a disaster where they have to pay out on the policy. We are getting in line with the professional insurance companies, even the casino, if you will. The reference to the casino being the house. That's because they take a little piece of profit on many trades. And that is exactly what we're doing in selling options. From our option strategies 10 module course, we have a live trading session for those graduates. So we cover everything, but we're all together, looking for opportunity together, assessing the best option trade, and trading them together. So we had this just 2 days ago. Here's one we found. We had an alarm set on XAR, which is the ETF for the defense and military stock sector. And as you can see, even though it's been a bull, a very strong sector since the Trump presidential victory, it's extended and rolling down. So the sector told us to go look for individual opportunity. We found a couple of them, but we liked the high implied volatility of Boeing. Had a nice double top, reversal bar, topping tail at a prior high. Now the stock was at 265 on this day right here, this morning, when we put on this trade. So here's the trade we did. We sold a 10 lot of the out of the money 270 calls, which are way up here. And then we bought a 275 call, just to convert it to what we call a defined risk trade, so that caps our potential maximum loss, and it's also less margin with your brokerage firm. We took in 55 cents a share, so on a 10 lot, that's $550. We don't care if this stock goes sideways, down, or it can go $5 against us, and we still make $550. We're only doing this, we're calling a short-term top just for 8 days. Not for a month, not for 3 months, for 8 days. And in our trade management, of course, our stop loss is over the high of this double top. So if it happens to reverse and make new highs, we will stop out of the trade, which, depending on how many days have expired already, could still be at a gain. So our time decay paycheck from theta is roughly, I just use straight line math. I took 550 divided by 8, although in real life they don't move perfectly like that, particularly since I showed you that time decay accelerates into expiration. It's not straight line, but you get the point. So as long as this stock stays range bound, this is roughly our gain every single day. Now, since the stock continued to fall the next day, even though it was a 1 day later, this option that we sold for 55 cents a share was down to 15 cents a share. So we closed it the very next day at 15 cents a share and locked in a $400 profit. That's just prudent risk management. Why do I want to wait another 7 days to make my remaining $150 when I have $400 in the hand in 1 day? So we teach strategies like that, of course, in our option strategy series course. Here was another trade we did in the live class. Now, so we sell premium the day of expiration, so it can be a few hour trade all the way. Well, we go out to 45 days in one newsletter, but in our weekly newsletter here, everything we focus on is 10-day expiration or less. That's for the maximum time decay gain on these patterns. So here's Macy's store. Part of the bearish retail sector has just gotten clobbered this year. This was a climactic buy setup into earnings. So this was an earnings trade. So part of our morning prep is our gap scans. And because Macy's just announced earnings, the implied volatility is very high. And I mentioned to you earlier, we like high implied volatility because the premiums are juicier and we get paid more for the bet that we're taking. So we love these, and we do a lot of these in our weekly newsletter. So we wait. Here's my pre-market. So the stock gapped up a little bit. This is all pre-market. Look, very bullish consolidation. Then market open here at 9:30. It went up into the 10:30 reversal. That's one of the concepts we teach for not only intraday trading, but getting on board swing trades. So that was our entry to short the out of the money $17 puts for 16 cents a share. So selling a $17 put means we have the obligation to buy Macy's at $17 a share on or before expiration, which was the very next day. In return for that, we got paid 16 cents a share. Now, some of you might say, Dan, that 16 cents a share doesn't sound like a very big deal to me. I want to swing for the fences, go for home runs. Well, we do in our directional trades. This is not a directional trade. This is an ugly downtrend where we're just calling a 1.5 day bottom. So 16 cents a share. The margin is roughly, you take 20% of the strike price. So I took in 160 bucks. My margin's 32.50. That is, ladies and gentlemen, 4.6% return in a day and a half. Get out your calculator and annualize that if you like, because you won't believe me if I told you. And the stock could go against us, provided it doesn't close below 17, and we've made 160 bucks. You can do bigger share size, we do more trades, but the intent of this service is to generate weekly and monthly revenue on compelling patterns by selling options. All right, so now let's get to Mr. Wall's question. He was asking, well, let me just define what Mr. Wall was looking at. So this was a trade we did. Arch, we sold the $65 puts. Now bear in mind, with Arch at 80, trading at 80, we had $15 of cushion where the stock could go against us and we still make our maximum money. So we sold the $65 puts, 31 days of risk for 950 bucks. And so the Greeks tell us how an option price should change based upon different factors. We're just focusing on theta on this lesson. So my option quote screen here with Thinkorswim says I should make roughly 41 bucks a day in theta, which is time decay income. So the put seller, which was me, this is my order entry box, earns that in time decay, and so you can see that's the main reason why we love selling options around patterns. Now you can see here I sold them for $9.50. The current price was $7.50 if I wanted to close it, and that's why it's reflecting a $200 open gain right here, unrealized. But now let's get to Mr. Wall's exact questions. So, Mr. Wall, the maximum gain on selling any options is the premium received. I sold this one naked, so I took in $950. That is my maximum gain. So this short put, this unrealized price, or the current price rather, if I wanted to close it, it's going to go down in value, which is what we want, right? We want to sell options at a high price and buy them back or let them expire worthless at a low price. So these are the things that are going to make this option price go down in value. One is if Arch, the stock, moves higher, because then delta, which measures my directional risk, is getting smaller. There's less likelihood of this option expiring in the money, so it's worth less. Passage of time, that's the focus of this lesson. That's my theta income. Day by day, as long as there's no disaster gap against me, I'm making money. It's a wonderful feeling. Volatility contraction, for you guys who want to study up on Greeks, that's your vega risk. When we're short options, we're short volatility, we're short vega. If volatility goes up, it helps option buyers. If it goes down, it helps people like us, option sellers. And then he asked, what does this cost for me to put on? Well, selling options doesn't cost anything, and there's no margin on options. So if you were to buy options, you got to pay 100% of the price. Selling them just consumes buying power. If you did a spread like we did in Boeing, it's the difference of the strike prices less the premium you already put in your pocket. If we sell them naked, it's roughly 20% of the strike price. So you would just, eyeball it 60%, or sorry, 20% of $65 is my margin if you want to calculate the ROI on this trade. So just to conclude here, this is our weekly MasterTrader options trader, and our goal, I showed you two examples. We generate weekly income by looking at compelling price patterns, and we're just saying the odds of this pattern violating it are very low. And even if we're wrong, we manage in between. We combine the MasterTrader method with chart patterns and volatility analysis to sell these, and we do them over and over again. We have defined a specific 50 to 70 liquid optionable stocks, ETFs, indices, commodities, currencies, and we scan those every single day looking for opportunity. And you can go to our website here and read up more on this. But it's only 19 extra bucks if you are a subscriber to our advisory letter already. So we already booked $560 in a day in those two trades, so you can see how 19 a month is just immaterial. That's all for this video. Be sure to subscribe to the Chart of the Week and check out our advisory letters on the website if you're serious about wanting to make money investing and trading. And keep watching these videos here and in our YouTube channel. We've got tons of great content to help you learn our simple approach and generate wealth in the markets. Thanks so much for watching, happy trading, and see you next time.